my very simple model for this is I think about almost like three ways. One, you have tokenized treasuries becoming more and more, the reserve backing for stablecoins. We're seeing, some of the protocols. Shout out to M0 and that team that they're using on-chain collateral for the reserves. To then be able to see, okay, this stablecoin is backed by, I think it's Superstate as one of the tokenized assets. Then you have the ability to say, okay, can stablecoins enable 24/7 trading of tokenized assets? And what's the benefit there, and being able across the world to get access to a tokenized version of Apple stock or some fund that you can then trade in real time with the stablecoin. I think that's interesting, and BlackRock talks about the benefits there. And then the one I think is most interesting is tokenized assets as collateral, to be able to use in a smart contract to be able to borrow, and being able to have stablecoins as the way that those loans are dispersed. And so I think once you can represent many different types of assets on chain, what can you actually do with them? And it seems to me the most interesting thing you can do with them is actually be able to use them as collateral and create new types of credit markets, with those assets. And so I could see this world where like stablecoins have already hit escape velocity. Tokenized real world assets are much kind of lower in terms of, was it a few $billion in terms of the total market cap? But they will continue to come closer together and interact with each other. And I think BlackRock has obviously been really at the center from a mainstream large financial institution that's trying to drive this intersection.